Starbucks isn't just a coffee company, it's a global lifestyle brand. But with rising costs, fierce competition, and shifting consumer habits, the question is clear: can Starbucks continue brewing growth, or has it already reached its peak? Today, we'll break down the numbers, the opportunities, and the risks behind one of the most recognizable names in the world of coffee. Starbucks was founded in 1971 in Seattle, Washington, and has since grown into the world's largest coffeehouse chain. With more than 35,000 stores across over 80 countries, Starbucks has transformed coffee into a global lifestyle experience. The company's business model goes beyond selling beverages. It builds customer loyalty through premium branding, store ambience, and a powerful digital ecosystem. Starbucks is not just about coffee, it's about community, convenience, and consistency, making it one of the most recognizable consumer brands worldwide. Starbucks holds a dominant position in the global coffeehouse market, with over 35,000 stores worldwide and a brand that has become synonymous with premium coffee culture. In the United States, Starbucks commands the largest share of the specialty coffee segment, far ahead of rivals like Dunkin' and Peet's. Internationally, the company continues to expand aggressively, especially in China, which has become its second-largest market. Yet competition is intensifying, from local coffee chains that appeal to regional tastes, to fast food giants like McDonald's offering cheaper alternatives. Starbucks differentiates itself through scale, brand loyalty, and its digital ecosystem, but the challenge remains: can it sustain growth while defending its premium positioning in an increasingly crowded marketplace? In its most recent quarter, Starbucks reported steady revenue growth driven by strong demand for cold beverages and continued expansion in international markets. Comparable store sales increased, with the U.S. showing resilience despite inflationary pressures, while China delivered double-digit growth as mobility improved. Operating margin expanded modestly, supported by efficiency initiatives and digital engagement through the Starbucks Rewards program. Overall, the latest performance highlights the company's ability to maintain momentum in both mature and emerging markets, reinforcing its position as a global leader in specialty coffee. Following the latest earnings release, Starbucks shares saw a mixed reaction in the market. Investors welcomed the strong international growth, particularly in China, but concerns lingered over rising labor and commodity costs. The stock initially moved higher on the headline revenue beat, yet profit margin pressures tempered enthusiasm. Analysts highlighted that while Starbucks continues to demonstrate brand resilience, the market is cautious about whether these gains can be sustained in a high-cost environment. Overall, the earnings reaction reflects a balance between optimism about global expansion and skepticism around near-term profitability. Now we are looking at a small portion of Starbucks' financial ratios for fiscal years 2025 and 2024. For fiscal year 2025, Starbucks recorded a gross margin of 71.1%. This means that from every $100 of revenue, about $71 remained after covering the cost of goods sold. Compared to 72.1% in fiscal 2024, the margin slipped slightly, reflecting higher input costs and wage pressures. Return on invested capital came in at 7.9% in 2025, which means that for every $100 of capital Starbucks invested into its business, it generated about $7.90 of profit. This is lower than the 11.4% recorded in 2024, when the company produced roughly $11.40 of profit from every $100 invested. The decline shows Starbucks was less efficient in turning capital into profit in 2025, signaling challenges in maintaining productivity and profitability compared to the prior year. In fiscal year 2025, Starbucks posted a free cash flow margin of 6.6%. This means that from every $100 of revenue, the company kept about $6.60 as free cash flow after covering operating costs and capital expenditures. In fiscal 2024, the margin was higher at 9.2%, meaning Starbucks retained about $9.20 from every $100 of revenue. The decline shows weaker cash generation efficiency in 2025, as rising costs and investments reduced the amount of cash left over for dividends, buybacks, or reinvestment. Overall, the drop in FCF margin highlights tighter financial flexibility compared to the prior year. In fiscal year 2025, Starbucks reported an interest coverage ratio of 6 times. This means its operating profit was 6 times larger than the interest expenses it needed to pay, showing the company could comfortably meet its debt obligations. In fiscal 2024, the ratio was stronger at 10 times, reflecting a much wider cushion between profits and interest costs. The drop from 10 to 6 times indicates that Starbucks' financial flexibility has narrowed, leaving less room to absorb rising costs or additional borrowing. Even so, a coverage of 6 times still signals that Starbucks remains capable of servicing its debt, though with less resilience compared to the prior year. Looking ahead, Starbucks has several powerful catalysts that could strengthen its stock performance. First, the company continues to deliver solid comparable sales growth, with the U.S. showing resilience and China returning to double-digit expansion. This broad-based momentum highlights Starbucks' ability to sustain demand across both mature and emerging markets. Second, emerging market expansion remains a key driver. Starbucks is aggressively opening new stores in China, India, and Latin America, regions where middle-class growth is fueling higher transaction volumes. With plans for more than 600 net new stores globally in fiscal 2026, expansion is set to accelerate revenue growth. Third, Starbucks' digital ecosystem and loyalty program are proving to be major strengths. The Starbucks Rewards membership in the U.S. has reached over 35 million active members, while delivery revenue has grown sharply. These digital channels deepen customer engagement and create recurring sales. Fourth, menu innovation continues to capture new consumer trends. Cold foam beverages, for example, grew 40% in U.S. stores, showing Starbucks' ability to adapt and expand its product mix. Combined with operational improvements like the Green Apron service model, customer experience is being elevated further. Finally, Starbucks has laid out a long-term financial framework targeting 5% plus annual revenue growth and over 2,000 net new stores by 2028. This disciplined roadmap provides visibility and confidence for investors seeking sustainable growth. Together, these catalysts, global sales momentum, emerging market expansion, digital loyalty strength, menu innovation, and a clear financial strategy, position Starbucks to reinforce its leadership in specialty coffee and potentially drive its stock higher in the years ahead. Despite Starbucks' strong brand and global presence, several risks could weigh on its stock performance. The first challenge is margin pressure from rising costs. Labor wages and commodity prices continue to climb, eroding profitability in North America, Starbucks' largest market. Analysts have noted that margin expansion targets are at risk as cost inflation persists. Second, unionization and contract negotiations remain a significant overhang. Starbucks Workers United has intensified demands, raising the likelihood of higher labor expenses and potential operational disruptions. This creates uncertainty around future cost structures. Third, analyst skepticism and valuation concerns have emerged. Some firms have downgraded Starbucks, citing doubts about its ability to sustain a turnaround in a competitive coffee market. With its valuation still above industry averages, investors worry about limited upside. Fourth, operating margin contraction is already visible. In fiscal 2026, North America's margin fell by roughly 170 basis points due to higher product and distribution costs, as well as legal accruals. This signals that profitability in its core market is under pressure. Finally, macroeconomic headwinds, including inflation, tariffs, and global volatility, could dampen consumer spending and increase costs. In China, structural changes to joint ventures are expected to reduce reported revenues, adding further uncertainty. Taken together, these negative catalysts highlight that while Starbucks remains a global leader, its near-term profitability and financial flexibility face meaningful challenges. Starbucks' fair value is around $84, while its closing price on April 30, 2026 stood near $105, signaling the stock is overvalued. Strong Q1 2026 earnings fueled a two-day rally, but investors see valuation approaching its maximum near $115, making the stock vulnerable to profit-taking. Starbucks delivered strong Q1 2026 results, fueling a short-term rally in its share price. Yet the recent surge also raises the possibility of profit-taking as investors weigh the sustainability of this momentum. Solid revenue and earnings growth highlight resilience in operations, while North America margins remain pressured by product and distribution costs. The brand's global strength continues to support long-term prospects, and investors may balance short-term gains with long-term positioning. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.